Well, for a day that there was basically no news out there, it was a pretty good day for mortgage rates. So what I want to show you is just a snippet from a CNBC interview with one of the Fed people that sit on the Federal Reserve with Steve Leisman on CNBC. It's kind of quite interesting. Pay attention when he talks about immigration. He mentions that a few times, and then how there is non-equality among different income classes on how they're being affected. So, Steve, please take it away with the Fed Reserve speaker.
With Fed Governor Chris Waller. Governor Waller, thank you for joining us.
Thank you. Hey, by the way, I hear birthday wishes are in order.
Thanks very much. That was not on the agenda here today. We've got a lot to talk about, but thank you very much. Can we dive right in and talk about the inflation dynamic as you see it? How was 2023 in terms of what has been called really the solid progress that was made in inflation differed so far from 2024? And how does the dynamic going to work this year?
Yeah, so I would say 2023, the second half of the year, we really did see a lot of unwinding of supply side problems. We also saw a large surge in immigration that wasn't really appreciated until much later. And that did a lot of things. One, it had a very positive effect on growth, employment, but at the same time, prices were coming down, which you typically would think would happen with a supply side. But the first quarter of this year, and what we're staring at now, kind of looks much more like demand side. So I've kind of argued in the past, a lot of supply side stuff, except for the immigration, is kind of unwound. And so what you're staring at now is much more demand. And that's where policy is going to have bite to kind of bring the economy back into a more moderate state and bring inflation back down to target.
So to the extent that you said this morning in your speech, you expect inflation progress to continue. Is it from the demand side and the weakening demand that you expect progress to happen?
Yeah, that is my view. Others may not, but that's my view, that the supply stuff is pretty much running its course. It's kind of hard to appeal to pandemic supply side problems when every firm I talk to are like, no, supply side is not really the problem. So in that case, it really is demand, and in that sense, it's just, strong consumer demand. They're basing that off of a very good jobs market. Their jobs are secure, their real wages are rising, and that gives you confidence to consume, particularly in the middle and upper groups. Now, some of the lower groups we're seeing a little more stress.
But you've seen some weakening overall in April, and that you think helped bring down the inflation numbers?
Well, the inflation numbers are kind of, they're kind of middling around the 0.3 monthly numbers. That's why I was joking this morning. The second digit seems to be a big deal, whether it's above 0.3 or below 0.3. But I think it will. Whatever we saw happen, we're going to see policy start to put more downward pressure on demand. We're seeing it through the labor market. We're starting to see it in surveys of manufacturing, non-manufacturing, things I mentioned this morning. So I think keeping the policy rate where it is, it's restrictive. That'll continue to sort of slowly grind down the economy, but not throw it off a cliff.
Tell us how you measure restrictiveness in the policy rate.
Well, I'm going to do the standard thing, which is I'm going to take the policy rate, and then I'm going to take off, expected inflation a year out. And when you do that, and those are roughly around 2% or a little above, so you're staring at a real policy rate of 2.5% to 3%. And I think that's by most kind of estimates a restrictive stance.
Okay, so I want to show you the math. So here's what he's talking about. When him and other policymakers say we're in restrictive territory, here's what they mean. They take the federal funds rate. So I did all this through Chat GPT. So I said, what is the federal funds rate today? That's what the Federal Reserve controls. That rate is 5.33. That's how much this rate was, like 0.25 3 years ago. So it's gone up 5% since then. Okay, so then they look at what the inflation rate is. And we're going to take, I just Googled it or chatted it here. It says 3.4. Okay, so what you do is you take the 5.3 federal funds rate, minus out the 3.4 inflation, gives you a positive 1.9. He said 2%. That means if the number is positive, it means it's restrictive. The rates are high enough to kind of curtail people from buying and spending and things like that. So this was good news for today. We saw the markets kind of coming off their lows that we saw. We had mortgage rates go up since I left. Remember, I was complaining earlier. I'm like, well, when I left, rates were 6.9. When I came back, they're 7.1. Where are they right now? Well, they're at 7.05 or right around there right now. So this is basically what caused this spike in mortgage-backed securities. So if you're a little confused, how do we monitor mortgage rates on this channel? Well, we watch mortgage-backed securities, a bond that trades on Wall Street. Why? Because the yield on this thing is the biggest part of your mortgage rate. Okay, so when the price of this bond, how this works is if the price of the bond is going up, and you're seeing it's going up 18 ticks right now, that means mortgage rates are coming down. If this number was going down, we'd have mortgage rates going up. So it kind of goes in a yin-yang relationship. I also wanted to share one thing. I got this from Realtor.com today. Fantastic article I wanted to share with you guys. May Housing Report. There's a ton of data packed in here, and it tells you, a whole bunch of things through here. And not a lot of people might say, oh, okay, this is Realtor.com. You can't trust any of this data. Guys, they can't come out here and just make up stuff. Okay, so you can see through here where house prices are going up, days on market are going down, and so forth. But the one piece of this puzzle I want you guys to see, and I'll put the link down below. You can subscribe to it if you want, but cross-market demand, market hotness, realtor affordability, and all this. You go down through here and just click View All Reports. Fantastic reporting here. Areas that are hot, areas that are not, areas that are the market hotness areas where people are actually buying into some of these areas, national trends, cross demands, all kind of things. So I'm not going to go through this report here because everything is local. Where you live, it might be different from the next person. So I want to give you the tools in your hand to make an educated decision when it comes to home ownership. So if you get to the point and you're like, hey, Dan, I'd really like to see if I can buy my first house. Maybe I'd like to buy a second home. Maybe I want to buy an investment property. What can I do? A lot of people are confused when it comes to this. So I'd love to be your mortgage person. I'm licensed in all 50 states as well as Puerto Rico, so there's no reason not to use me. And I'm also one of the country's largest mortgage brokers. We're set up with right now a little over 30 different lenders. And you might say, Dan, you had 70 recently. We purged a lot of them. We got some companies went out of business. Some just weren't giving us the rates we needed. Some weren't using technology to its full capacity. So we skimmed that down and we just want to use the creme de la creme. So what you're going to do on our channel is you're going to apply for a loan right up through there. We're going to take one application, one credit pool, and we're going to search the whole country, over 30 or 40 different lenders to see if there's a better program out there for you. Being a broker allows me to use that lender's products as well as that lender's rates. So not only are you providing you programs from ServBank, where I work right now, but lenders all over the country. I'd love to help you. And if you want to reach out to us, just click therateupdate.com or scroll to the bottom. You can apply right there or scroll to the bottom. You're going to find two other ways that you can reach out to us. You can give us a call at 844-775-5626, or you can email me, and yes, it is me directly. You can email me at dan@therateupdate.com. So thanks so much for watching, guys. The Closing Bell with Dan Frio. I'll be back tomorrow with a whole nother series of videos. Have a great night. See you tomorrow. Bye-bye.